When you think of a bank, it may initially appear as a secure haven for your money, with few considering the hidden intricacies hidden within its walls. The level of financial literacy remains relatively low, and this contributes to the significant wealth disparity prevalent in the world. It is imperative to recognize that attaining wealth is intricately tied to possessing the knowledge and skills to effectively manage money. Interestingly, billionaire Henry Ford once remarked that it is fortunate that many individuals are unaware of the banking system, as this knowledge could potentially spark a revolution. Welcome to Nova Society, the world's best finance channel for personal finance. If you are interested in this kind of video content, then this is the perfect channel for you. Make sure to like this video, click the subscribe button, and turn on the notification bell to keep you updated on our recent uploads. The first recognized private bank in history is attributed to the Partnership of St. George, a consortium of private users from Genoa. In the 12th century, this bank extended significant credit to the authorities of the Genoa Republic for a war effort in 1148. In return, the partnership was granted the authority to collect certain taxes from citizens, leading to the formation of the Bank of St. George after 1407. During this time, people held a mixed perception of the banking system. On one hand, it was seen as a reliable and conventional financial tool, but on the other hand, bankers were often viewed as greedy or deceitful individuals. Money lenders were even denied communion and a proper Christian burial. It is difficult to assert that modern society's perception of bankers has drastically shifted. Here are the secrets that banks did not tell you about. Banks don't store money. Promotions often display deposits as a reliable method for generating passive income. However, this approach to earning money faces many challenges in many countries. The primary issue lies in the fact that deposit interest rates fail to keep up with inflation rates. For instance, in Switzerland, leading banks offered deposit interest rates ranging from 0.5 to 1.5% in 2020, while the average inflation rate was between 1.5 and 2%. Consequently, it becomes clear that the income generated from deposits is ultimately eroded by inflation. Banks deliberately keep interest rates low as it is not advantageous for them to increase the returns on your deposited funds. Instead, they benefit from using these funds by lending them to other clients at slightly higher interest rates, profiting from the interest rate differential. This system allows banks to circulate money, granting not only the deposit owners but also the government some level of control over citizens' funds. Banks serve themselves. Banks prioritize their interests, with other customers being secondary. This is because once money is deposited into a bank, it becomes an asset for the bank, and any money borrowed from the bank also remains its asset. Banks hold an advantageous position, almost always benefiting from the arrangement. Their primary focus is on increasing interest and maintaining control, rather than advocating for the individuals who entrust their money to them. It is essential to recognize that once your funds are within a bank, they no longer solely belong to you, they also become assets of the bank. The credit limit of a bank is determined by the number of deposits it holds, and this ratio often favors the bank, creating an unfair dynamic. Banks don't give money to people who look poor. Bankers, who are known for their presentable and professional attire, tend to consciously or unconsciously make judgments based on the appearance of those around them. If a customer does not present themselves well, the bank may hesitate to provide them with a loan. If the borrower appears to be in dire need of the money, their chances of obtaining it are likely to be gone. On the other hand, if the customer gives off an impression of not needing the funds at all, they are more likely to receive what they desire. However, there is an exception to this rule when the customer already holds a bank account. In such cases, the bank staff can verify the individual's financial status through their account. However, if no account exists, the bank will rely on the customer's appearance to form rapid judgments and draw conclusions accordingly. Bankers get an annual bonus for loans. They don't tell you this, but bankers receive an annual bonus, but it is typically granted only to those responsible for loan issuance, usually managers. The bonus amount depends upon the loans approved, with the condition that they are reliable. As the year draws to a close, employees at the bank may be more inclined to approve loan applications, often unintentionally. Initially, there may be no pressure on managers to approve loans, but as the year-end approaches, there is a concern about missing out on the bonus if sufficient applications are not approved. Bank employees may fear losing their yearly bonus if customers are unable to secure the requested funds. Wealthy individuals benefit from this system by visiting the bank to obtain the maximum possible loan amount, borrowing their collateral and credibility. Banks make money on you. Banks possess a precious asset in the form of their client databases, which they effectively use to generate new offers and increase their profits. It is not uncommon for banks to sell these customer bases to other financial institutions, including microcredit agencies or even fraudulent entities, depending on the integrity of the bank's employees. It is worth noting the commission fees associated with credit cards. There are two methods by which banks can profit from you: offering a card with a specific status that requires a fee, or implementing a so-called shadow tax. The latter involves secretly charging you for credit card usage, often going unnoticed. In theory, the tax should be imposed on the seller when you purchase with your credit card. However, the seller may inflate the price of the goods, effectively causing you to indirectly pay the shadow tax. Better terms for the rich. Banks, like any other business, operate intending to generate profits and are accountable to their shareholders. To ensure their survival, banks prioritize lending to affluent individuals over those with fewer financial resources. The rationale behind this preference lies in the fact that if a wealthy borrower fails to repay the loan, they have the option to sell a portion of their business to settle the debt. Additionally, banks may favor lending to wealthy individuals as a means to secure potential loans from them if the bank faces bankruptcy. Hearing those things rather than simply depositing your money into a bank, it may be more beneficial to consider investment options or allocate funds towards a business venture. Instead of relying heavily on credit card usage, opting to make cash payments can help avoid potential pitfalls like the imposition of hidden fees or the so-called shadow tax. Well, these banks know how to keep their secrets. If you want to learn more about personal finance and generational wealth building strategies, visit our channel and subscribe for more enlightening videos to increase your wealth.